2026 right and get it right for your pensions. So each webinar is different. And so welcome, one and all. Let me know where you are in the world, of course, on the chat. I've got a different set of slides. We've got to cover the markets and everything else. I'm going to share my screen with you. You should all be able to hear me. We've got Chesterfield, we have Aylesbury, we have a lot of different places. So we've got a really good one today because I've been working on just communicating more things about the markets, but in different ways, and just trying to find new ways to simplify what I want to communicate. So as ever, this is not a solicitation to buy or sell any individual stock. It is for educational information purposes only. It is not individual personal financial advice. Okay, we've got the legal stuff out of the way. The agenda as ever with this series, they'll all be different. Every single one of these webinars has been different to the previous ones. So we're going to have the first 15 minutes going through the market update where I see 2026, 15 minutes key investment lesson, and 15 minutes Q&A. Okay, on all of those things. So thank you, Peter. Good morning from London to you in New Zealand. Peter, I emailed you 2 of your model portfolios. Hopefully you received that email safe and sound as of yesterday. Now, good news, I got this today, achieved December 29th, 6 million views on YouTube. So if you're not watching me on YouTube, please do. What was interesting is the last 500,000 views came in just 1 week, which is nuts. I don't think I've grown that quickly ever. So it seems to be compounding, hopefully like our portfolios in 2026. I've lost count of the year. We should have Paresh on as well. Hi, mate. Hope you can hear me.
Yeah.
We should be able to hear you. Oh, this is the point at which the microphones usually go off. No, I'm okay. Can you all just make sure you can all hear me? Paresh, give me a thumbs up if you can still hear me.
Yeah, I can hear you. All good.
Let's start with the politics then. So I'm going to start off with what's going on politically, of course. And retail investors have been shying away from 60-40 funds. Let me just explain what these are and why this is hilarious. Okay, so 60-40 funds are this sort of old-fashioned way from, oh God, the 1960s, 70s, 80s, where 60% is equities, 40% is bonds, regardless of your risk appetite, regardless of your age. And to be honest, 60-40 is more suitable when you're maybe 60 years old, all other things being equal. Anyway, retail investors have caught on that their growth is crap. Because 40% is basically cash. So, you know, the stock market might go up 25% and they're wondering why they're lumbered with 10% growth. And because they're in a 60-40 fund, okay? And the fund is underperforming the index on top of that because of fees. So 25%, the stock market goes up, they're ending up 10%, they're thinking they're being left behind, but it's a 60-40 freaking fund. And now, at long last, JP Morgan have discovered that retail investors are not as stupid as they thought and that they're moving away from them. And they're doing what you guys are doing. They're on webinars and they're sort of learning for themselves how to buy the stock directly and, you know, being 80-20 or 90-10. invested. Anyway, that caught my attention today. I'm going to go through a few more things. Europe looking strong, probably strong into next year as well, but we'll go into some of that in a second. Nvidia still on a buying spree. Those AI companies are profitable and they've got cash. If you've got profits and you've got cash, I'm not worried about you. And so all this talk that we've been having about, oh my God, it's the bubble, should be worried. Of course, you can still have a down year like 2022. If you look at 2022, it's really instructive. Look at Meta in 2022. It fell 75%. And then the next year, it went up 300%, i.e. recovered everything it lost. The point being that you can be a great profitable company, as Meta is and was, but you can have a nasty down year. That shouldn't lead to panic or boredom. And what we can do if that happens this year, I'm going to show you later in this webinar, so it's really important. Peace in the Middle East and peace in Europe. Those are two things which have not happened for about 2,000 years. Neither peace in Europe nor peace in the Middle East. Okay, whether it's the British fighting the French in a 100-year war, I mean, 100 freaking year war, that really takes some kind of anger because that's intergenerational. Or home of world wars, and so on and so forth. This, therefore, doesn't impact the stock market. Essentially, wars don't impact the stock market because the stock market is largely a Western phenomenon, and the West is used to having background noise of conflict. So whilst I don't think the Russians are going to come to some kind of peace agreement, it's not going to affect things. Will it affect defense stocks? Yes, as an item of noise. Okay. Those defense companies, just like NVIDIA as an AI company, can look good on their balance sheets, their P&L, and their cash flows. That's why you should buy them, not because you're an AI expert or a defense expert or taking a punt on AI or taking a punt on defense. You buy them because the financials look good, regardless of the reason. Just as Crocs you might buy because the financials look good, not because the bloody shoes do. Similarly, defense companies will only be interested, we will only be interested in if they come into our top 20 to 40 out of 10,000 stocks. The narrative that these websites, and why I like showing them to you so you can understand how to read this news, because I've been a co-host on CNBC many, many times. I've had 250 shows on Bloomberg. I've got a pretty good idea how you read these headlines, okay? And they're trying to get you to do stuff like click the links, for instance, so you can see the adverts. The fact of the matter is that whether Trump, as I've just been listening to his speech from Mar-a-Lago, or is he back at the White House? I think he's back at the White House today, actually. Trump threatens to knock the hell out of Iran if they build weapons. That's for the defense companies or whoever. It might be Palantir. It might be Palo Alto Networks. It might be Microsoft to convert that spending into profits and for it to pop up on our list of companies we want to hold. Okay. So one thing we don't do is we don't go for those narratives. Okay. Whether or not there's more or less defense spending, we really don't know. As it happens, U.S. defense stocks slide. Now, Zelensky doesn't call me, and neither does Trump. I wait by the phone. They don't call. You don't call. The point being, that kind of noise I don't care about. What is important is who is booking the sales and the revenues. And those numbers we can get because they have to file those legally. And that's a hell of a lot simpler way of doing things than anything else. Now, in 2026, I'm not going to be buying Tesla stocks, even though I think Tesla over the next 3 to 4 years will do very well. And he's friends now, is Elon, with the president at arm's length. They're not holding hands, they're at arm's length, but they're friends because of the volatility. And I want to make the point to people that just because you think something's going to go up doesn't mean you got to take a bite out of it. Okay? NVIDIA takes $5 billion stake in Intel under September agreement. Intel's been quite volatile for me. Okay? It's been one of those turnarounds. So Intel's another one, which we can look at it later. We'll look at specific companies, which I reckon it will do well because the government's got all these rulings that basically the government's got a stake and everybody's got to buy Intel, and they've all been told you better shore this up. And I'm sure the Trump family have got holdings in it as well. If I'm wrong, sue me. But it's a bit too volatile for me. So I don't just want companies which I think will go up. I want companies which will give me good night's sleep. My age, that's important, good night's sleep. Micron's one of mine, but I don't have eBay or the others. We'll go at the bottom. There's nothing at the well. There you go. Tesla's down 3% anyway. Now, China wants AI chatbots to stop manipulating users' emotions under new draft rules. Seriously? China doesn't want to manipulate people? Don't worry about it. We're really good at it in the West. We're as good as the Chinese. The whole Chinese AI story, if you remember, they're going to create cheaper AI. No, everybody's just creating a bigger market. AI profitability continues into next year. But I'll tell you what other predictions I've got. I've written 12 predictions for the next year, and I'm going to go through them in a second. Of the other stories on here, I'm not seeing something which says to me that the music is about to slow down. Okay, Paresh, have you got any? I mean, that doesn't stop it. Like 2022, the music suddenly slowed down because the Federal Reserve said we're going to tighten interest rates, and the markets fell 25%. So I'm not saying it can't. It might do. It might do. The markets might fall in 2026, but at the moment, we can't see that far ahead. Even though it's only 3 days away, we can't see that far ahead. So we're continuing on our current course, like a pilot. We're flying ahead through fog, but we don't see a reason not to land, that we won't be landing safely at our destination. We can divert to another airport if, like 2022, there is a sudden reason for us to call Mayday, Mayday, and ditch the plane and go into cash. Paresh, Your thoughts on that while I set up the screen?
Yeah, well, it's how we used to on the hedge fund, how we used to play with news, particularly as non-farm payroll, sort of PMI and the core economic data that used to come out on the floor used to move markets for that moment. Yeah, and they will generally give you a direction of where markets may be traveling, but that's for that moment. Generally speaking, on stocks, though, we used to use news to our advantage in that typically on a Friday, if there's volatility and volume on any stock, on a Friday, we'd be buying it, and on a Monday, we'd be selling it. This is trading. This is not investment, of course. So what we understand is take any news with a pinch of salt. Don't get bogged down by what you're reading as gospel. So yes, I would read it out of a matter of interest, but I wouldn't sort of make decisions based on the news you see on these wires.
Yeah, it's very seductive to try and do it. Look at this. Tech sell-off weighs in on US stocks as silver plunges. Now, silver, it's the Chinese who've been buying it. Gold, all-time highs. Copper, all-time highs. But, okay, how do we encapsulate that? Well, if we, first of all, say we're not going to be trading those because we're not here to trade. If we want to do trading, we'll do a separate webinar on that. So we're not here to trade. So then we think to ourselves, well, we'd have a commodities exchange-traded fund or a metals exchange-traded fund, and we'd probably only want 5% of our capital in it, and we'd want it for a long period of time because we're not trading. So we'd want it as a stabilizer in our overall portfolio, something which reduces drawdown somewhat. But if you wanted to take a trade on it based on just momentum, then I've explained it before. The MACD rule, and I'll show that in a second, works with the exchange traded funds pretty well. So you could take any exchange traded fund and basically buy when the monthly MACD is just starting to rise from an oversold position, hold while it's still rising, and then ease off your position it's falling. And I'll show you images of that in a second. But we're not here to trade, as I said, tempting though it is. It's a bit like, oh, you know what, I got a hot tip, put it on red at Las Vegas. Yeah, but that's not investing. And we're going to keep strictly to our discipline. So other than those, nothing interesting at the moment coming in. I mean, there's some side stories. I hope Anthony Joshua is okay. It looks like he is, but sadly lost two coaches, two trainers in the car crash in Nigeria. Just shows you at this time as well, we've lost we just got an email just now, one of our Great Investments Program students sadly passed away of cancer. And his wife wrote a lovely message saying, make sure you spend time with your family. Here we are doing a webinar, but I'm sure you're all with your families and all mindful of that, but we do forget sometimes, I guess, don't we? I'll tell you something funny that just happened before I went on air. My wife came over and gave me a peck on the cheek. My wife she hasn't done that for 10 years. So that was nice and timely of her. Now, what I'm going to do is I'm going to go through a little bit later on some of the individual stocks, and we're going to go through any stocks you want me to look at as well. But what I want to do, having covered the economic side, which was pretty easy to cover today because it's no news is good news, I want to give you 12 predictions, okay, for 2026. I keep forgetting which bloody year it is. It still feels like yesterday was 2000, So prediction one, strong global economy, okay? These are the big numbers. But what do you want me to say? They're obvious. They're simple. Move on, Alpesh. Those are the numbers, okay? When there's conspiracy theorists who will say, oh no, the market's going to crash. Well, off the back of those numbers, the thing which could make the market crash, okay, there's four things. One is something happens to company profit and losses that we don't know about. There's mass fraud amongst many companies, like .com crash. All of a sudden we realize, oh, none of these companies are profitable. Well, that's not happening. Secondly, cash flow. There's another COVID-like shut the economy down. That could happen. Something comes out of God knows where, shuts it down. I don't think so. It's a, black swan event, low probability, but then again, nobody expects the Spanish Inquisition. Okay, so that's cash flow. Next one, balance sheet. We suddenly reevaluate our balance sheets like we did in the financial crisis and say those houses aren't worth what we thought. Well, these assets aren't worth what we thought. I can't see where that's coming from. I'm not seeing any hints at it. I'm trying to look and find on the dark web where it might be, the dark financial web of, the people I could speak to. We're not seeing that. So those are three. What's the fourth thing? The fourth thing is something institutional, like suddenly we're going to start rising interest rates unexpectedly, like 2022, or there is something institutionally not working that we're not aware of. All of a sudden we discover that there's some shock to the system, like the oil price shock of the 1970s. Something happens which causes some kind of spike, which again, that's the whole point of a crash. If you saw it coming, it wouldn't be a bloody crash. I mean, so I don't know what that fourth one is. But so I can tell you that for the moment, our aeroplane remains on course. Okay, so that's my first prediction. Pretty easy one, you might say. As part of that prediction, I'm going to give you this prediction. And you might want to take a picture of this, because if I may say so myself, this is bloody good. And I try and find new ways of communicating things in ever simpler formats. I actually want to make it so good that it's a piece of art and you put it on a wall and they exhibit it at a modern art gallery one day. Okay, I know, I'm cuckoo. So this is related to the first prediction. The markets can only do three things in 2026. And I'm going to be right about this. Okay, I just don't know which one of these three and when. Yeah, make my life a bit easier. Path A, 2022 type, they fall back, in which case we get a daddy bear. I'll come to what that means in a second, and we'll possibly exit and buy back cheaper, but we'll see. Path B, short, sharp fall, like COVID, like February to April this year, and we do nothing, or we exit, but end up buying back more expensive. Okay, we'll definitely get a path B at some point in 2026. Okay, guaranteed. I'll guarantee that. Path C, continued rise. We let in as one. We'll get path C as well, obviously. Okay, so I think it's going to be C for sure, B for sure. Would we get an A at some point? I just don't know. I hope not. Okay, but we've got a strategy for each. Think of this like a battle plan, all right? We're generals getting ready to go into war in 2026. There's our battle plan, and we've got a strategy for each outcome. So we sleep easy at night. Okay? I mentioned Anthony Joshua just now, the old famous boxing quote. Everybody's got a plan until they get punched in the face. Well, even if we get punched in the face, that's our plan. That's our plan. Because our plan is also, we ain't going to panic. We will not panic during any of this. So we're not worried. Well, we're not going to get bored. There's your plan. I mean, you could print this. Personally, I think this should be printed out and put on people's desks. I don't need to because it's in my brain. The hardest decision in 2026 you'll face with a great company, and don't own anything which isn't a great company. And how do you make that choice? 26, a great company like NVIDIA, I guarantee you this is going to happen. And the best thing to do is, whether you're going into battle or whether you're playing a game of sports, whichever way you look at the analogy of the markets, when you imagine what you're going to do in that future position, it makes it a lot easier. Sports people will tell you this, okay? So a great company like NVIDIA will inevitably put you in a difficult position. Its price will dip. And you'll have two choices at that point. Your decision will depend on what kind of a driver or investor you are. You'll either sell to buy back cheaper. That's the kind of thing Paresh, on the hedge fund side would do. It's as a floor trader would do. Requires good timing, quick reflexes, constant monitoring. He's had mentors to give him advice and tell him, look, Paresh, Goldman's are doing this, you do that, copy. So, you've got a lot of support and stuff. That's the pro choice. Sensible choice for most people would be to buy more as it falls. Okay, it's systematic, it's less stressful, leverages the long-term quality into the business. Okay, unfortunately, your average, what's the most boring car there is? Your average Volvo driver likes to think they're a Formula One driver. We all do. I used to own a Volvo, by the way. I think they're phenomenal. But I don't fool myself that I'm a Formula One driver, okay? If I'm in the Volvo. Now, if we do the sell to buy back cheaper, as we did in 2022 and did in this year, but this year we ended up buying back more expensive because of a V-shape, we'll let you know in the Telegram channels and the weekly updates. I'm just saying, for most people, if you don't hear from me, you should really be doing the sensible choice. You can only do the sensible choice if you've got a great company to begin with, okay? A market fall isn't a crisis. Don't panic. It's a pit stop. Sooner or later, every race has a pit stop, and a down year is inevitable. I'm not saying it's going to be 2026. I'm not stupid enough to try and predict that ahead of time, but I'll tell you how we'll know when it's happening beyond prices falling. I'll show you in a second. And if the market falls and I've got a portfolio of great companies, I'd buy more at a cheaper price. If the market rises, hey, I spend more time tanning my gorgeous legs in the Indian Ocean. That's it. That's the plan. Prediction 2, the S&P 500, everything depends on the monthly S&P 500 MACD. Everything on what we're going to forecast for you is going to depend upon this one thing. Now, this is one way to put it. If the monthly MACD indicator is rising, we'll stay invested or add cautiously even possibly, and this is the current state. If the indicator is falling, i.e. mummy bear, and I'll show you it in a second, we'll probably begin to ease back, or we'll be a bit cautious in terms of what we buy and so on. And number 3, if the indicator crosses below the average daddy bear, we might exit to go into cash to avoid a deeper fall. That is it. Again, another one you could take a picture of and print out. Now, you'll notice with all of this, we've not tried to be outsmarting the rest of the market, because we assume that Paresh and I don't have, well, a time machine, a crystal ball, or the ability to see into the future. In fact, Goldman Sachs and Morgan Stanley have, and this is the easiest way you find out not to do that, is they have diverging opinions on which way the market's going to go. So with all their Wall Street bros not being able to work it out, what makes you think 2 blokes in hoodies are going to, actually the ones in hoodies are probably the smarter ones, can do. So that's why we don't try and, it would be sexy to say it. I mean, it would look really clever and, well, I think it's going to be this, it's like going to a casino and we're saying, no, it's going to be red, trust me. Comes up red, people think you're a bloody genius, okay? So where is the S&P 500 at the moment? This is where it is. So at the moment, got no decision to make. Alpesh, is it going to be a mummy bear? I don't know. Well, Alpesh, take a guess. Why should I bother taking a guess? I don't need to take a guess, so why should I take one? We're talking about money. Why should I bother taking a guess for no good reason? At the moment, just stay the course. Yeah, but Alpesh, what if it becomes a mummy bear? Well, I've just told you the strategy. What if it becomes a daddy bear? I just told you the strategy. Well, how will I know it's going to happen? Well, because I do broadcasts 2 or 3 times a week, mate. Well, I'll keep on top of it for you. Simple, calm. Now you can go to bed. All relaxed. Okay? Prediction 3. I probably won't exit any of my model portfolio stocks. And the reason for that is they're meant to be held for a longer period of time anyway. And I don't think there's going to be a daddy bear. So that's my prediction for 2026. I don't think I'll be doing anything for a whole year. What with the portfolio? I think I will be doing a lot of broadcasts on TikTok, YouTube, talking to a lot of people. Can you imagine? I mean, we used to do this with Bloomberg TV. I'd do a lot of TV shows, a lot of content. At the end of the show, you take your script, you put it in the bin, because tomorrow's another day. What a waste. All that work from morning till night. Put it in the bin. I expect I'll continue holding these, just some of the ones I've got. I don't see any reason at the moment to sell them, but who knows? Who knows? My JP Morgan is up. We'll see in a second. I think it's about 40%. I didn't know it was going to be up 40% in the last 12 months. I wish I did, because I would have gone to JP Morgan Private Bank and said, can you lend me £10 million? I'll return it in a year. Lend me at 8% interest rate. I'll pay you back 800 grand at the end of the year. And I would have bought their own shares with it, which, by the way, would have been illegal if they knew that I was going to do that, because they're not allowed to. You can't finance your own share purchases. And they would, and I would have been up 40% on the time. I would have pocketed 4 million, let alone the 800 that I paid back, 3.2 million up. 3.2 million up. if I knew it was going to go up 40%. That's how you make money. I didn't do that. Why? Well, I like to sleep easy at night. Because if my wife got wind of that, she might say, well, wait a minute, sunshine. What if it drops 50% this year? That's how Nick Leeson lost money. It's the extreme event, the black swan. The one you think won't happen, that when it happens, the 1 year it bloody happens. And that's how long-term capital management hedge funds blew up. It's how during the Russian financial crisis many moons ago, it's how they all blow up. Because basically, ultimately, all finance is the same. It's taking a leveraged, if you really are greedy, a leverage bet on a black swan event not happening. And then guess what? Sooner or later, it happens. And that's the time you blow up. The 99 times it doesn't happen, you raise capital, you become a billionaire, and you just hope you can push it off. And when you see, if you Google hedge fund collapses, they all inevitably have the same story. The black swan event happened more often. The rare event happened. Anyway, so those I expect. What will happen with the FTSE 100? My next prediction, which isn't written down here, it won't outperform the US markets, because for it to do it 2 years in a row is like England winning 2 test matches in Australia on the trot. I think it happens with the same level of frequency. So I tell you what, if England win the next test match in Australia, then the FTSE is going to outperform the S&P 500, because it looks like it's, and the black swans were discovered in Australia, but everyone thought they didn't exist until then. Those rare swans which are black. Going back to FTSE 100, it's not going to outperform the US, is my prediction for 2026, because statistically it doesn't tend to happen, and the economic backdrop just isn't justifying it. Okay, I'm afraid. Prediction 4, I probably won't exit. Did I just say that? I think I've rewritten that. And the reason I won't exit, deja vu, I won't exit them is this. I think they will perform. I think what I meant to write was my model portfolios, never mind my own one, but the ones, so some of my family members are in some of these, will perform in line. Well, what does perform in line mean? It means they'll have one of the, think of it like bingo, okay? They will have a performance which will be one of these numbers. I just don't know which one. So to give you an example, the uncle who's in the Rob O portfolio, who's up 45% this year, might end up minus 13. I just don't know which one of these numbers it'll be, but it'll be one of these numbers. Okay? And I was like, well, that's a bit rubbish. Yeah, because if you can predict even more closely than that, well done. You must be some kind of a genius. So I expect all the model portfolios will continue in this kind of realm, what you see on the screen. Okay? And by the way, the S&P 500 and the SPDR UK All Share are not our models. They're just indices. They're just there for example. We won't want something as crap as the FTSE UK All Share performance. Although this year's unusually good, generally tends not to be. A bit unusual. And after a very strong year, it tends to be followed by a pretty poor year. Anyway, so I think that's going to continue. Prediction 5, I expect a 40% return on my portfolio, but I can live with 0%. Why? Because 2022 was 0%. You've got to be able to live with that. Can happen. But I expect a 40% return, because I expect it'll be something like this. Okay? This is one of our models. I expect we'll end up doing something like, I should have written 30 to 40, but let's say 40. I'm going to call it similar to one of the best years there. Why? Because the background market is expected to continue being strong. And if it doesn't and it's 0, so be it. It'll happen the year after. But this is similar. This is one of the models we created. I expect it'll do a good return in 2026. But I can't guarantee it. I have an expectation that my son will win the Nobel Prize in economics, but I can't guarantee it. Do you see what I mean? I can have good high expectations. I'm expecting that's the most likely outcome. And by expectation, if my expectation is based on what I think is the most likely outcome, that is the most likely outcome I think in 12 months will happen with the model. Okay, but this is the reason why, and this is the danger, that it could end up being like this. That's the same portfolio. It's got a 30% average because it's done 38, 43, 42, 26, 0. That's what the returns are. Okay? It's unusual. But given the economic backdrop, I'm fairly confident. But I'm not reliant on it. It doesn't impact my spending or lifestyle habits, even if it's 0%. Okay? Funds will underperform benchmarks in UK and US. So this is my next prediction, and this is such an easy one for me to make. Fund managers will underperform their benchmarks, whether they're UK fund managers or US fund managers. And this is because this happens every year, and it's guaranteed to happen again. Okay, it happens every single year. This is from the Financial Times. Top 10 underperformers, it's going to be AXA, Aegon, St. James's Place, Fidelity, and Lion Trust are all going to have a plethora of funds, which are not going to only underperform their benchmarks, but a plethora of their funds are going to give you a negative return with those fund managers. And I'm guaranteed to be right because I'm always right on this ever since I first wrote about it 25 years ago in one of my FT columns. Okay, so that's definitely going to happen.
Can I? Sorry.
Yeah, go ahead.
I'll go back to that slide.
Oh, yeah.
Okay. So there's a little story here I'd like to share. And it's related to a friend of mine who works with Aviva. He told me this a few years back, so the numbers have probably changed. But when I say a few years, this is 8 years ago. He said he doesn't manage funds. He is responsible for allocation of funds from pensions that people have taken out, like you guys would have taken out with whoever, maybe St. James's Place and Fishers or whoever, and it all gets collated and given to Aviva, Fidelity, or whoever. He alone is responsible for collecting 180 million pounds a month of pensions. Then he has to allocate across several funds, depending on what you've ticked, saying this is my risk profile, these are the areas I'd be keen to invest in, whether it's US, Europe, India, or whatever. And he doesn't have enough products to place it all. So they end up with about 80 million, half of that, to go into other funds which closely link to the ticks you guys represent on those forms you fill in. So the reason they perform badly is simply it is a spray and pray. I've heard it from the guy who does it pretty much every day. This was literally 8 years ago, and that was 180 million. I suspect it's a lot more now, which goes back into why this market generally will, every time it falls, you should be looking at buying more. Because when it's falling, there's a wave of money coming into the markets every month in any case.
Yeah, but looking to buying more of quality companies. And I've summed it up in this infogram where basically if you've got a quality company and the market falls, you're winning because you can buy it back cheaper and it's a quality company. So you have made a return because you bought more of it at an even cheaper price. If it's a quality company and it's a V-shaped recovery, well, you go back into profits. And if it's going up anyway, then you're obviously in profits. So it's win-win. But that predicates that you've got a value growth income approach, that you've got what's a quality company? Undervalued companies, which are revenue growth, earnings growth, because we know the academic research shows undervalued companies tend to do better than overvalued ones. There's a shocker. Growing companies tend to do better, but not guaranteed to, than ones which aren't growing. There's a bloody shocker. Companies generating dividends tend to do better. Warren Buffett made his career on just doing that and then doing nothing else for a reason. It bloody works. By the way, 90% of US GDP growth is fueled by AI spend. The spending on AI is almost like a new government has come along and is just throwing money at the economy. Now, at some point, that will become inflationary. At some point, it'll become unsustainable because it's like putting water through a pipe. You can't rely on humans to do it at the right speed. They sometimes do it too much and it becomes, right, it gets too explosive and there's your bubble, your bounces. So no skin off our nose if that's this year. If it happens in 2022, fine. Then 2026, like it did in 2022, fine. 2026, we'll end up holding cash and we'll get heavily in 2027 and make all our money back and look at our returns over a 2-year period and say, wow, they're still averaged out annually. Brilliant. Okay, we can't help it if 2022 happens. I just don't think it's going to happen this year. But then, by the way, 2021, this time 2021, December the 29th, 2021, I didn't think 2022 was going to be a down year. It was only when we started looking at the monthly MACD that we said, we better be in cash. I didn't know. I couldn't see that far ahead. I'd love to tell you, between me and Paresh, you should see the certificates we have on our walls, and we can see into the future, and we can make us sound great, make us sound like real heroes, and we're the man. But the truth of it is what I've told you on YouTube videos, and I've done it week in, week out. Now, when that dips that's when we'll know. And I've said it on my Bloomberg shows all those years ago. I tell you openly, everything I know, I'm telling you. There isn't something I'm holding back. So we'll see. But either way, we're not worried, because the companies we've got are the ones who are solving the problems of how to make the money, how to generate the profits, how to grow the revenues, how to keep paying the dividends. Okay. The problem with the fund managers is just summarize that. I won't even have to say it, because I say it so bloody often. I'm fed up of saying it. I think those images sum it up so beautifully well. What the problem with the fund managers is. I might actually take a picture of that. Actually, you know what? I'm going to do that. I'm going to take a picture of that. I'm going to send it to the CEOs of each of those companies. AXA, Aegon, St. James's Place, Fidelity, and Line Trust. Why don't we do that, Paresh? I'm going to send to each one of those, send a picture of that, and just tell them, listen, you're in a massive scam. They're in a massive scam, okay? Because what they should actually be doing is picking from a giant... They should be doing what the private banks do, which is individual clients, talking to them individually and saying, right, your portfolio should be out of 10,000 stocks, these 20 or 40 companies, and you should hold this much in cash because you're old, you should have more in cash. Simple. They won't do that because the manpower it requires to do that doesn't make it economical. The private banks do it because you've got to have 50 million in the bank before they'll do it for you. So there's a gap between the retail mass market, we're going to screw you, and the private bank Goldman Sachs. And that's the gap we're trying to fill and saying, well, wait a minute, why can't we give the Goldman Sachs treatment to the average retail investor and say, well, it should be bespoke to your needs? Prediction 7, my son will turn 8, God willing, okay, and be on course. What do I mean by on course? That's him since zero, basically. His portfolio is not exactly grown like that because 2022, he had cash that was like zero. It was flat then. But essentially, the boy's grown up on Meta, Amazon, Microsoft, Alphabet, Apple. Then after 2023, NVIDIA, not before 2023, NVIDIA, okay? And he's got some more now, but of different companies. And not many, I think. I think he's got some Goldmans in there and some JP Morgan as well. But this is his junior ISA, and that's what's going to happen, okay? So I think he'll remain on course in 2026. In fact, it'd be hard to understand, well, what does not being on course look like, Alpesh? I don't know what not being on course would look like. I guess it would look like all those companies going bankrupt and shutting down and all the money going. You know, winners will be those who are calm. That's my prediction 8. You might say, oh, those are pretty easy predictions. No, because I'm also educating you about something about 2026, which is going to happen, which is this. Playbook rule number 1, think portfolio, not stock. The winners will be the ones like Warren Buffett who think portfolio level, not, oh, my stock's down, I must panic. I expect every stock to go up. Warren Buffett has never had a single year where every one of his holdings has gone up. Even he doesn't just pick one company for that reason. We're going to think portfolio level. Those are the people who are going to win, not the ones who look at individual, oh, one of my stocks is down, what should I do? But looks at the overall portfolio. The winners will be the ones who, Paresh, you do that. That's in honor of you, mate. Yep. Bit of meditation.
Thank you.
The physique slightly different to yours, but you get the point. The noise you are being told to worry about today, you can ignore. War in Europe, AI is a bubble, global debt is 100 trillion, tariffs and trade wars, US markets dominated by 5 AM. You're going to keep getting that noise. That's what's there to knock you off course. The ones who win will be the ones who will be calm and say, yeah, I knew you were coming. The five horsemen of the apocalypse, the market apocalypse, is going to be these things you're going to keep hearing. Okay? You're going to keep hearing these things. I could have probably thrown in a couple more from somewhere. Warren Buffett always says the thing that he worries about the most is the thing he doesn't know that's going to happen, whether it's nuclear war or whatever. And we might look at this time next year and go, shit, who would have thought it's fill in the gap? Okay, fill in the gap. That's why I'm not in the prediction business. Playbook rule number 2, only own what you'd want more of if it drops. This is why we look at value, growth, income, cash flow, Sortino, alpha, all of those things, and do a sanity check on the individual companies. Are they the type we'd want to own more of if they drop? Most private investors can't pass that test. They own things that if they fall, it's like, oh shit, it's fallen. What do I do now? Okay. That's the problem. Again, take a picture of this if you wish. These, do you know what, Paresh? We should print these out and sort of sell them on Etsy as a set of cards. Actually, cards you could hold on your desk just to remind you. You know, they have those annual wisdom. So it could be just, you know, for each day of the year, you go through these. If anybody thinks that's a good idea, let me know in the chat. Might do it. We might actually create some for free, and then people who come on our webinars get those delivered free. Through the post. The Contrarian Investor's Manifesto. Stay calm. Do nothing 99% of the time. This is your manifesto. Filter the noise. Think portfolio. Buy on a sale. Trust the data, not stories and narrative. Own the best. There's your manifesto. I mean, that is right up there with, I don't know, Labour, Conservative, Reform manifestos, Lib Dem. I think it's better than all of them. I think it's better than any government manifesto. And I tell you what, it'll do more for you than bloody governments will, I suspect. So the Calm Investor's Playbook, a disciplined approach to the stock market. This is how I give my son a bedtime story. It's not really, but it might be one day. So, you know, once upon a time, there was a man sitting under the tree. His name was Gerald. He was investing, but 99% of the time, Gerald was doing nothing. His friend, Geraldina, was trading and looking for constant action. Anyway, you can imagine how the story might go on. We might create, Paresh, we've got to create a children's book. Do you know what? The Kid's Guide to Investing. Yeah. Wow. And these are the images. There you go. Kids book. That's enough. If anybody thinks that's a good idea, let me know. Book number 19, Paresh. And these are the, look, I'm not going to read all of this, but this is what you're going to do. And, you know, and then the little monster came. The little monster was called, he claimed to be a saint. He called himself St. James, and he lived in a place called St. James's Place, but he wasn't really a saint. He was the devil in disguise. Anyway, I guarantee you all I am teetotal. Okay. Wall Street and the media, this is what they're going to do. Ignore the noise. There's going to be a lot of news. Now, I tell you this as somebody who, as I said, co-hosts CNBC, does the newspaper review on the BBC, Bloomberg TV shows, and writes for the Financial Times. And I'm telling you, ignore everything we say. Okay? And you might think, what? Well, maybe I'm the only one in a position to tell you that. It's noise. Read it for interest, like you read a novel. You know, you might read a spy novel. Doesn't mean you go out and think you're James bloody Bond, does it? Yeah, for fun. Prediction 9, the year of quality company investors. So investors in quality companies, it's their year, not the speculators who will end up being roadkill. There's going to be people speculating on quantum companies, nuclear fusion companies. The volatility is going to be greater this year because it's the potentially fourth year of a bull market. They're going to be roadkill. The ones who are going to win are the ones who are value growth, income, cash reserves, not predictions, headlines, sectors, narratives. Okay? It's not your problem to work out if it's data centers or something else that's going to make money. That's the problem with the board of Microsoft. When you've bought their stock, you let them get on with the job. That's what's going to be. Thank you, Gary. I think the kids' book would be a great idea. Not least, I give it to my son. I think we could be onto something there, actually, Paresh. Hardest decision you'll face with a great company and how to make it. I've mentioned this before. The sensible choice is what we're going to go for. The market rewards good behavior, not risk-taking. Master these three motions. Don't panic when the market's falling. Don't get bored when the market's sideways. And don't get elated when the market is rising. Paresh and I happen to be, I'd like to think, quite religious. Not going to go into a whole religious diet.
Not religious, but spiritual.
I've never known the difference, but we'll discuss that some other time. But anyway, we'll discuss it some other time. But a central tenet of our faith is detachment from reward. You do your duty, you remain detached. And that's the best to do with the markets. Be detached. What comes will come. You don't have the right to the rewards of what's going to happen, you have the right to do your duty. Your duty is to be detached and unemotional with good quality, and your duty is to pick good quality companies for your family and for yourself. That's your duty. Pick good quality companies for yourself and your family and be detached. You don't have the right to what's going to come from that. You're not entitled, to put another way, to what's going to come from that. But what should come from that, you should be rewarded with the returns. Okay? Prediction number 10, AI, quantum computing, and nuclear fusion, and war. I predict war. Haha, what a genius, Alpesh. You predicted war? Could have been right any year for the last 2,000 years. AI, this is the speed at which it's going up. I was watching a video late last night on YouTube where somebody was saying how they were on version, 5 of ChatGPT, version 4.5 of ChatGPT, or 5.2, I forget which, and Gemini's on version 3. And they made the point that I'd made previously, I think to you, Paresh. Microsoft used to come out with a new edition about every 2 years. There's this other company which is saying they do a new update every day. They don't even bunch them together. They're just updating every single day. And it's interesting because when I do a TikTok live, if I do it one day and then the next day, they've updated the software and I have to download it again. And at first I thought there's a glitch with my computer. Then I realized, my God, this is the era we live in. Every day's an improvement. Not every 6 months, 12 months, or whatever, which is why we live in an era where billion-dollar companies are being created within 12 months. It used to take a couple of generations. It's now happening within 12 months. And AI is a massive reason for that. Now, I can think of lots of reasons why it's going to wipe us out. We don't need to worry about AI destroying us, okay? Because apparently they've discovered the universe is not expanding anymore. It seems to be contracting. So you thought the climate was a problem. There's a bigger climate out there which is going to contract in on us. I say that tongue in cheek. Is Costco a stock you would buy on the way down? Costco is not one of the ones on my, it's not a bad company, but it's not one of the ones on our filters that's clicked all our greens, as far as I remember. I don't remember seeing it as all greens. It's one that I've liked in the past. And all other things being equal, if I had no other data and information, the likes of which I've got, then yes would be my short answer to you. However, we happen to know we've got better companies than even that. Prediction 11, big is best, but unpredictable. What do I mean by that? I mean this. These companies with the biggest amount of money are the ones who are absolutely bankrupting everyone else, taking all the talent from everyone else. That's why they keep getting fined by the EU. They are bullying their way, and Trump's caught on. Hell, these are American companies. The one way to conquer the world without firing a single missile is let these companies loose on the world. They're American after all. And Trump's not the first person to think that. East India Company, ever heard of it? The British had that idea as well. Get a company, get it abroad. That's how you take over countries. I don't think Trump's actually worked out that he's not original on that one. But anyway, these are the modern East India companies. They are, if you don't believe me, you ask somebody setting up a business in Britain about Amazon, and they'll tell you, oh no, they're destroying our business. They've got an unfair advantage. They can undercut us, etc., etc., etc. East India Company, similar criticisms. They just don't have a militia. So these East India companies are the ones, for now, I don't have to think 20 years ahead, I'm just saying for now, which will continue being the biggest winners. They'll be slightly less volatile than the others. We will do special reports on quantum computing, nuclear fusion, and so on, out of interest, but I don't see any of those going into my pension directly. They might go because Microsoft's bought a nuclear fusion plant, or Meta has, for instance, but they won't go in because I've directly invested in those. I'm not that exciting to do that. Prediction 12, most people will not sort out their pension growth. They just won't do it. Okay, this is what, according to various sources, people have in their pension pots, which sadly is too little, and this is what they should have in. Take a picture of it. I won't go through it. This won't change in 2026 because it doesn't change ever, sadly, for a whole variety of reasons. It's not necessarily your fault. You might be being paid too little. look, there's all sorts of reasons we don't have enough in our pensions. It's not necessarily because it's our fault necessarily. Okay. So those are raw numbers. As I said, take a picture if you wish. One of the most important things you can do, and came from AJ Bell, they ran the numbers, is if you increase annual return, we're talking really poor annual return here, from 4% to 6%, just 2% more makes a massive difference, let alone if you get a good stock market and you can ride it. One of the biggest unfortunate things that's happened over the last few years is we've had one of the best bullish stock markets, and people have just not ridden the back of it, unfortunately, because they didn't know how, they didn't know what to do, they were too timid, they didn't realize it was going to be so strong, whatever the reasons were. They didn't invest enough, in other words. Okay. But increasing your contributions and increasing your contributions and working longer is not the best solution, because who the hell wants to save more if they don't have to, and who wants to work longer if they don't have to? Getting a better growth return is a far better solution because somebody else is doing the work. I mean, the number one route of getting rich, get somebody else to do the work. Okay. In this case, we want Microsoft or JP Morgan or whoever to do the work for us. Might be Adobe. Adobe's not one that I own. It's one of those which, could be great if they get their act in order. Intel could be great if they get their act in order. Unfortunately, they're not showing it at the moment. Could be United Healthcare, because it's one of those which has generally done very well, except this year, year after year. Could be McKesson, which is one I own. So these are the problems. We're going to still, at the end of this year, or in 12 months' time, still be trying to solve these problems. Okay? That's another guarantee I give you at the end of 2026. We're going to still, and we're still going to be having our list and going through our filters and creating the portfolios and trying to hit those numbers. Okay? That's what we're doing, and trying to minimize that number. It's simple. We're making rockets. How do we make rockets? This is rocket fuel. And we make rockets by trying to get that as big as possible, but assuming it'll only do half as well, and getting this as low as possible. That's our job. I draw down, think of it like friction on a rocket, and think of this as trajectory or rocket power. Okay? And one of the metrics we use, which we'll continue using this year, and it will continue working for us, will be this: cash return on capital invested. We want that to be as high as possible. Okay, we want that to be as high as possible. We want it to be companies in the top 25% by that number. If they're not, they tend not to be the biggest performers, because money gets soaked up. Investors go to those companies because those are the ones generating the most cash. They're the ones most likely to outperform, and Goldman Sachs' data proves it, and we just copy what they do. So we shove it all in, shove in the croaky, get 15 to 40 stocks as we've got in the models, and that's what will happen. And this, I'll give you another prediction. I won't outperform 2023. 2023 was knocking the ball out of the park, 80% in 12 months. That won't happen again. And I've said it before. I'm almost saying it to tempt the gods so that they prove me wrong, because I hope they do, because that'd be nuts. I mean, it's just nuts to get that kind of return in a pension. I also want to show you, let's go back to world economics and the markets. Feel free to add any of the questions as I am speaking, as we get onto this. But what you can see I'll just go into today's market. So that's the last 12 months. It's unusual for the UK to be ahead. You might say, what about global markets, Alpesh? I'm just going to close the Dow for a sec. Actually, no, I'll leave the Dow there. So that's emerging. Okay, whoops, let's put emerging in there. And it had a surprisingly good 1 year. But you want to look at it over prolonged periods. Emerging, I'll just remove it so you can see it tends to be pretty poor. Okay, it's bottom of that pile over 5 years. Okay. You might say, what about throwing in a Japan? Okay. Now you might say, well, wait a minute. Why would you want to own any of these? Presumably for diversification. Well, actually, if you look at how correlated they are, you're not actually getting much diversification either. Okay. Well, throw in India, Alpesh. Okay, I'll throw in India. A bit volatile. Is it diversified or is it still correlated? This is the point about how the world has become so much more correlated that what happens in America really impacts everything else anyway, as we know through the tariffs. If it didn't, he wouldn't put tariffs on. If the world was so isolated, then he wouldn't put tariffs on. But that's India over the last 5 years being thrown in. Well, what about China, Alpesh? Well, That's China over 5 years. Surely it's time for China to come around. Well, if you want to take that gamble, test the hypothesis if you wish. I'm sure it will sooner or later, but that surprises people how poor Chinese performance has been over the last 5 years. I'd rather do China through an Alibaba. Okay, I'd rather do it through an Alibaba than through a general ETF. Okay, top news, you can read it there. There is nothing, the new billionaires of AI boom, it's an interesting story that on basically the Silicon Valley companies, which are just doing nuts in terms of that. Locking gains, rotate risks, so be it. We'll see. But there's no big stories. Any questions at all on this? Will Canadians' exodus badly affect US? No, not yet. Canadians? You're worried about the Mate, Indians' exodus. Who do you think runs Silicon Valley? CEO of Microsoft, Alphabet, Adobe, Intel. Who do you think is running all the biggest American companies? That exodus is one I'd be more worried about, but no, not yet. Presidents come and go, remember. And then when the squeeze gets tight, they do U-turns on their policies. So not particularly worried about that. So there we go. Over 10 years, the NASDAQ is up 365%, and then you got Taiwan. There you go. You got Taiwan. You got Jakarta, ADA. I mean, you know all of this if you're really into it all. Let's look at the FTSE 100 over 10 years. Where's the FTSE 100? There you are. You got 60% over 10 years. No, that's the Straits Times. Sorry, you got 57% over 10 years. There's the FTSE, and there's the Americans, which is pretty much like their economy. They're just completely controlling everything. And sooner or later, the world's going to wake up and realize that these guys have got a monopoly compared to the rest of the world. And they're soaking up all the oxygen. Okay, and the Trump policy is that if JD Vance stays in, they'll do it aggressively, which is fine for us. We're invested in their companies. We've got mafia protection off them, but it won't be fine for other parts of the world, I suspect. If America's fairer and says, well, you know what, we'll break our big companies up as we did with the oil conglomerates, then they'll be doing all the rest of us a favor. They are in no mood for doing the rest of the world a favor. So you better get on and ride their coattails is one way to look at it as well. Would the new classification be beneficial to cannabis stocks? Gary, that is a niche question. And no, I think the way they're classifying stocks, it seems too much noise. I'll give you an example. You know, you look at sectors and you say, oh, is XYZ company in an index? Should it be part of communications or should it be IT? Is it in the S&P 500? All those things can give it a bit of a blip, but actually underlying what really matters over the longer term. So short-term trading, you might be right, but longer-term investing, fundamentals matter. That's all that matters as well. Okay, guys, if there's no more questions, I shall leave it at that. I've gone over by 15 minutes, which I really didn't want to do. Quarter-on-quarter GDP growth. Look at how good that looks. Those Germans are suffering a bit. But overall, the world is expected to grow by about 2.5%, thanks to the Americans, because they are, the Americans are to some extent the Chinese. The Chinese not effing it up helps. Okay? All good. I did a dabble previously. HL have stopped listing them. Oh, yeah, I think, there's some ethical thing going on with some of the UK brokers, isn't there? I don't dabble with cannabis companies because they don't meet our metrics of value, growth, income. They're just usually not big enough. They might be good for a punt and a blow, or what you do with an inhale. You're talking to a teetotaler. I'm not even excited by them. There was the micro dosing of the other ones, wasn't it? The other drugs. Anyway, I've forgotten the names, but nothing big came of them about 4 or 5 years ago. I've done CBD. It seems to make zero effect. Just to charge you more at Holland and Barrett for it if they put CBD on it. So maybe I'm just immune. Okay, guys, thank you.
Thank you all.
Anything you want to add in closing, Paresh?
No. I was just texting. Not major news, but one of the coaches that coaches Anthony Joshua, I was just asking him if he was in Nigeria with it. He was actually in Miami, but he knew the other coaches. So,
yeah, it's just tragic, isn't it? I mean, obviously, there's a lot of people who've died today around the world through unnatural causes.
Yeah.
Anyway, on that happy note, then I've got another webinar tomorrow, and I'll mix the slides up and make them different tomorrow, so it's not the same thing, and we'll look at different things.
Yeah, well, if anyone on this call who wants to join tomorrow have any specific questions that you want us to deal with tomorrow, then please email us.
Yeah.
Good. Yeah.
Absolutely.
Mix up a bit.
Okay.
Good.
Happy to do that. Yeah. Thank you all. Thanks everyone for being on, and look forward to speaking to you all soon. Thank you.
All the best. See you soon.
Thanks.